Why should we feel like we did a good job responding to the financial crisis, despite the fact that today unemployment is still a whole lot higher than anyone would like it to be?
This was a classic financial panic, the most dangerous type of financial crisis, and something that hadn't happened to the world in really almost 100 years. And if you look what happened in the Great Depression, when you look what happened around history, it is just devastating. In the Great Depression, you had a shock to wealth. GDP fell 25%. Unemployment went to 25%. And it took 10 years to get back to a place where, roughly like where we are today. Our crisis was caused by a shock that was 5 times greater. And because we responded dramatically more forcefully, much more aggressively, again, it was messy. It wasn't pretty to look at. We were able to prevent unemployment from rising beyond 10%. Economy started growing again within 6 months. That was not an accident. It was a result of a conscious set of choices to prevent the panic from getting so much momentum it would collapse the economy.
I think when people hear this, when they hear the argument that we were bolder here than we were during the Great Depression, it feels counterintuitive,
It does, yeah,
right? Because people can name so much that happened out of the Great Depression, right? The Works Progress Administration, Social Security. I mean, you can really just go down the line. What was it called? The alphabet soup.
Right. We did 2 sets of things that are very different, not just from the Great Depression, than really what almost any country has done in the 100 years since, or when Europe's done the last 5 years. The first thing we did is we used the full force of the central bank monetary policy, the fiscal authorities, stimulus, tax cuts, spending increases, as well as a set of financial programs to prevent collapse. We use those in concert together. Typically, what you saw in the Great Depression is they're working against each other, where you leave some of those tools unaddressed, sort of hidden in the closet. It was a little late at the beginning, and it wasn't sustained as long as we would like, but we used that full force of things very dramatically. The fiscal stimulus, for example, was larger than what Roosevelt did in the Great Depression in relative terms, even though it was a little over too quickly. It wasn't as large as we needed. So that was the first thing we did, which is use those tools very aggressively, but in concert together. And they were much more powerful together being used in concert than they would have been if they'd been used just individually. Again, simple reason. If your banking system is broken, monetary policy doesn't really work.
Right.
You can't get the oxygen where it's needed. Second thing we did was to do a very aggressive restructuring, recapitalization of the financial system, so that we cleaned out the worst parts of it and we left the core of the system with much more capital against future losses. And that meant the financial system was able to give more oxygen to the economy as it recovered. It wasn't a huge drag in the economy. And the tools we used to do that and backstop the commercial paper markets, the credit markets for the average consumer, they were very innovative, very creative. And their scale remarkable. We backstopped directly about $30 trillion in financial assets for a very complicated mix of programs. That had never been attempted or done. And it was the scale of that response that made it possible for us to get the economy growing again within 6 months, really remarkably quickly. And it made it possible for us to return to the taxpayer a positive return on the financial programs. Remember, people thought in even early '09 that we would lose $2 trillion. If you just look at the returns to date, expected returns, the taxpayer is going to earn, and we didn't do it for this purpose, they're going to earn between $100 and $200 billion. In effect, we made the system, the financial system, pay for the support we gave them. And we didn't do it for them, we didn't do it for the banks, we did it to protect the Main Street from a failing financial system.
You talk about in the book the paradox of financial crises, and it goes to this point exactly. When people, I think, look back on it and they think about backstopping these $30 trillion markets, when they think about bailing out AIG, there's a feeling that, one, it was really bad. Even if it could have been worse, it was really bad.
It was terrible.
And a lot of these guys got away. Right. And part of what you say in the book, part of what you're saying here, is that restraining the impulse to go in and punish was part of what permitted a speed of recovery than what we've seen in other countries and what we've seen at other times. Why would that be? Why wouldn't disciplining the market in a more aggressive way, making an example out of people, marching them out in cuffs, help at least set a lesson, bring confidence back to folks that we're setting the rules down and this won't happen again?
It's the core question, and it's what I try to explain and write about in the book, and it's the central paradox of panics. In most crises, most states of the world, The basic instinct you described is the necessary right instinct. You want people to fail if they took mistakes. You want them accountable for doing dumb things. You want them to bear the consequences of those choices. That's the natural response, and it's the right response. In a panic, though, in the classic financial panic, where the risk of complete collapse of the financial system is present, you're at the edge of the abyss, then you have to suspend that impulse, not indefinitely, but just temporarily, and make sure you're focusing all your attention on the simple moral imperative. And it's a moral imperative of keeping the lights on in the financial system. Because if you let the system collapse, the damage to the average person is catastrophic. Now, it doesn't mean you should suspend that sense of justice and the sense of outrage. It's just you have to figure out, you put out the fire first, and then you got to figure out how to not just create a stronger set of rules, but hold people accountable for what happened. And in our system, what we tried to do was put out the fires so we protected people from even more damage. And you're right, there's still a lot of damage. But then try to move very quickly to put in place a stronger enforcement response and to put in place a tougher set of rules over the system going forward.
Let me ask you a broad question about that. When you were going through it, or even just looking back now, did you feel that there were people who, in a perfect world, should be held accountable, or did you feel this was a systemic sort of period of overconfidence, and it wasn't that individuals were doing things that they should be, even in a perfect world, punished for? It's just that everything got a little bit out of hand.
No, there was a appalling amount of fraud and abuse and bad behavior in the run-up to the crisis that caused a lot of damage. And I think the American people deserved a more forceful enforcement response, more forceful response to that. And that was very important. In fact, you could say that period of optimism, the mania, the period of exuberance, it, in some sense, provided the oxygen for a huge amount of abuse and fraud. Mm-hmm. So absolutely, it was, there was a lot of it. You know, even if it wasn't central to causing the worst parts of the crisis, it was very damaging. And it caused a huge loss of confidence in the fairness of the system. Mm-hmm. But again, you have to, in a panic, because of the consequences of panics, you have to do a little bit of sequencing of your actions, and you gotta make sure the lights stay on first. Because if they don't, the damage to the innocent victim is much more traumatic. And why would that be just?
You ultimately end up, despite being, I think, pretty frustrated with the American political system, with a fundamentally optimistic take on it, that when the chips are down, the system responds effectively. Not beautifully, but ultimately effectively. And I was thinking about that a little bit in terms of which problems we are and are not good at solving. I think if you look back at the financial crisis, when firms were at the risk of collapsing, ultimately the American political system would respond. I mean, we let Lehman go. I recognize that, but nevertheless, we then had a really extended and continue to have unemployment crisis.
Right.
And at a certain point, the American political system stopped responding.
I agree with that.
We have decided to live with that. Right. Why do you think that is? Why do you think that the sort of urgent collapses on Wall Street did ultimately force action? Whereas at a certain point, we decided if these millions of people just become long-term unemployed, that is a cost that we'll live with.
I think in the midst of the darkest days of the fall of '08, there was enough fear and panic about the cost of the average American that Congress felt they had to respond. They didn't really know what it was going to take, but they really had to. There's no alternative at that point. But that wasn't because of the power of the institutions in Wall Street. It's because of a widespread recognition that the value of America's savings had just fallen by a level 5 times greater than what started the Great Depression. And it was a like overwhelming existential imperative at that time. You know, people have written over the time that our system is pretty good at crises. Really pretty good over time, facing existential threat, marshaling the unique strengths of the United States to deploy the type of response you need. And then what happened? What happened is that the basic divisiveness of the American political system, the loss of confidence in government, the scale of the political opposition to government, the scale of the skepticism about deficits in that context took over, and there was a bit of premature austerity fever. And that sapped the will and the strength to do a bunch of things that would have helped make the recovery stronger. We were growing, but growing at a pace that was too slow to bring unemployment down as fast as we could have in that context. So I guess you could say it was like like what history has shown about the United States, which is in the acute extremis, when you're at the edge of the abyss, our system, again, it's sometimes messy, responded pretty well. And remember, that was a very dangerous moment because we were in the midst of a political transition across parties, no strong governing majority in Congress, very dangerous moment. And yet at that moment, you had Democrats and Republicans come together and say, we're going to do what it takes in that context. That's a good thing for the country. It's not enough, though, because a lot of the challenges we still face as a country, they're going to require compromise and accommodation and legislation that's going to require majorities that include Democrats and Republicans. Unless we rebuild that capacity, it's going to be hard for us to make a bigger dent on some of these long-term challenges.
How different was dealing with Republicans in the House and the Senate behind closed doors versus what it was like in public at a hearing, or even not in direct negotiations, but just the two parties kind of coming to their positions and articulating them to the public?
Well, they're very different worlds. The world that most Americans see is a world of extreme adolescent political theater. When you're in a room and you're trying to solve a problem, you're working through something, it's a more encouraging, it's a sort of more encouraging thing about both those individuals on the Hill and their willingness to try to think about problems. Ultimately, what happens, though, is you leave the room and they go back and try to figure out, can they get the votes for something in their party? And most of the things that the country needs today, they're pretty divisive.
As a reporter, one of the things I found over and again is that all these processes begin in a room to some degree. And so when they begin, you'll call the people who are in the room. And these are the folks who have the information. And they'll say, God, that was really encouraging. I really think we might be able to get something done here. And with every step people take out of the room, and eventually you have to go out of the room, it becomes more and more remote, and typically it ultimately completely falls apart. And it often felt to me that the room doesn't mislead anyone in Washington so much as it misleads the people in it. Because the feeling of working things out on an individual level, it feels so normal, and as you say, it's more adult. And then when you leave that room, the basic dynamics of kind of American politics at this moment in time, with the parties as polarized as they are, take over. And all of a sudden, how good-hearted the individuals are doesn't matter that much anymore.
True, but remember, the people in those rooms are masters of the craft. They're realists. No naive idealists in those rooms. They're pretty pragmatic people. They understand the constraints. It's better to try. Mm-hmm. It's better to try rather than just sort of sitting back and saying you're only going to play at the level of theater. Mm-hmm. And unless you get in a room with people and understand what their constraints are, what their incentives are, what their interests are, what they need, there's no way you can govern compromise. So you have to do that, and it's worth the attempt.
There's a different spin on the room that I think relates to the question of whose problems we solve effectively. It has seemed to me that one of the inequities in the crisis response, as it has gone over time, is that Congress can do more directly for Main Street than the Federal Reserve can, or at least the Federal Reserve believes it can. And yet, Congress is much more gummed up by political polarization. And so the Federal Reserve has been able to continue what it sees as a pretty aggressive policy of helping the economy long after Congress has had to stop. And so you've had, it seems to me, a longer period of support. It's not meant to just help the financial system, but does help the financial system than we were able to get for Main Street, simply because the actual processes by which we help the two groups are different, and the Fed's is more technocratic.
The only thing that I want to change your view on a little bit is the way you describe the way those two different policies work and who they help in that context. You know, monetary policy doesn't exist to help the financial system. If you're going to just look at the history of mistakes of central banks, who bears the burden of the mistakes both ways? The burden of whether it's too much inflation or unemployment way overshooting, that's a challenge, a burden that the average person bears. So the reason why people have invested so much time and effort over time in designing institutions around central banks that have that level of independence and expertise is because it's the only way to improve the odds that the outcomes for the average person are better than we've seen in countries where central banks are not independent or they're run by politicians. Mm-hmm. So, in fact, you could say the opposite in some sense. You could say that in those more politicized systems, the outcomes of central banks are much more favorable to the financial interest than is true in a system with this degree of independence. But your central point is true that in our system of government, the fiscal powers that can affect the economy help us grow faster, bring down unemployment faster, equip people to compete more effectively in this tough world we live in. Those powers overwhelmingly exist, are Congress's powers. Any action has to go through Congress. So if Congress is unable or unwilling to act, then you're left with much worse economic outcomes than are achievable. And the Fed cannot compensate that for that. Mm-hmm. It just puts a greater burden on the Fed instruments to do it, but it can't compensate for that failure.
Right. I wouldn't argue that the Fed is motivated by the banks. But what I would say is that the set of tools the Fed believes it has right now, and sitting not too far from me is Matt Iglesias, who thinks that Ben Bernanke should be doing something a whole lot closer, or now Janet Yellen, rather, should be doing something a whole lot closer to just sending people checks. Right. But in terms of the powers the Fed feels that it has, you've got a lot of money and a lot of easing going to the financial system, and the banks are not often taking the next step of lending it out aggressively, of actually pumping that money into the economy. Congress could do that. Congress could take those really low interest rates and turn them into tax cuts, but they're not doing that, or they could turn it into infrastructure investment. Right. And so it doesn't seem to me in any way to be an issue of motivation, but is a structural issue in the way economic policy is set and who has control over what in the American economy. It has seemed to me that there is a greater capacity to respond at this point to problems in the financial system than there is to respond to, say, the fact that the labor force participation rate has fallen and is staying a whole lot lower than anyone thinks is a good thing, because that requires Republicans and Democrats in Congress to come together and agree on some kind of remedy.
Yeah, I think we're in violent agreement, which would be better for the country if you had more active. Yeah, if you had a more active fiscal powers deployed to address these things like high levels of long-term unemployment and growth that's not as fast as it should be. I completely agree with you. Just one qualification, since you raised it, when the Fed lowers interest rates or holds long-term interest rates, when that works, it works in part by raising the value of people's savings and lowering the price of their mortgage, how much they have to pay for their mortgage in that context. And when that works, it works because it changes decisions people make about how much they spend and how much they borrow, and because it improves the rate of income growth for the average person in that context. It's just that, so I say it a little differently, it's just that the power of that instrument is inherently limited.
Yeah.
And it can't compensate for the failure to use those other things that effectively. And you're right, in that there was that moment of peril when we used those two tools and the financial programs in concert with pretty enormous force. But maybe in some sense the cost of what happened in that context was the constraints of the political system reasserted themselves kind of quickly, and we lost the power to do enough fiscal.
Well, one of the weird dramas of most of the last 5 years on Capitol Hill seemed to me to be Ben Bernanke as Federal Reserve Chair, a George W. Bush appointee, going up and begging Congress to use the money he was giving them. I mean, you talked about interest rates a second ago. It always seemed to me that Ben Bernanke had a really big housing plan, which was, I'm going to bring interest rates down to almost nothing. You guys need to help everybody in the country refinance their mortgages. Right. And there was a plan for that came out from the Obama administration, and it never went anywhere in Congress at all. So the Fed did take the hard part of that tool and put it on the table. Yeah. But the next step that had to be taken, which is to actually push the banks and make it simpler through Fannie and Freddie and other things for people to go and use that money.
A little better than what you said, though. Something north of 20 million Americans refinanced in the crisis. And about a third of those, I think, were directly things that were supported through our programs for Fannie and Freddie. The rest of it was just the natural fact that interest rates came down, and so was economic for people to refinance. Now, we had a bunch of proposals we gave Congress for expanding the reach of those things. And again, it would have been better if Congress acted on those things. And so I guess I'm agreeing with you again.
Let's talk about those housing programs for a second. When I talk to folks both inside the administration and out, the part of the crisis response there is the most either ambivalence or anger over is the housing side.
Absolutely.
And you kind of hear, I mean, there are a couple of dimensions of this, but two of the main ones are, one, that there was money sitting in administration programs, sitting in Treasury essentially, that was not used. and that could have been used theoretically with executive action.
Can I just respond to that piece?
Yes.
Yeah. So we put aside $50 billion from the initial TARP authority to spend on housing programs. And we supported over time a pretty broad mix of programs. And when the money wasn't flowing as aggressive as we thought, we substantially increased the incentives in them. We did that over and over again. But we found over time that we couldn't get enough take-up. But we tried to be as aggressive as we could in using it. And we had the right incentives. I mean, we had some of the best minds in housing in the country sitting there accountable for this. We had the president putting enormous pressure on us. We looked at every idea, and we tried a huge number of things. And we were as frustrated as everybody was with this. And certainly the president was frustrated. But we had the right incentives, and we worked really hard at it. We were very creative, but we were unable to figure out a way to get a reach broader than what we had and to have it more aggressive. But it wasn't because we were not focused on it or not worried about it, not trying. And we did a lot of experimentation.
What is it that, why did the program so underperform? When you guys dug into it, what did you find was actually the obstacle?
Well, let me step back in and try and do what we try to do and what we achieved in this context. We tried to do three key things. One was to make sure housing prices didn't fall. They fell 30%. When the president came in, the futures market said they were going to fall another 20 to 30%. That would have been devastating. So we were very focused on reducing that risk because this is the most valuable piece of savings for most Americans and it would have been devastating to the economy. Very successful, putting a floor under house prices and ultimately helping them start to get going again. We did that in part by what the Fed did, in part by trying to make sure that people could borrow to finance a mortgage again. Those markets didn't shut down dramatically. Second thing we tried to do was to make sure people could refinance on a broad scale. That had big tax cut-like effects, very substantial. In some sense, for the average person who refinanced, those tax cuts were larger than in the Recovery Act in that context. And again, somewhere north of 20 million Americans were able to do that. That's a pretty broad reach program in that context. And then we tried, and this was the hardest thing, to help as many Americans as we could who could afford to stay in their home if you gave them some help stay in their home. And ultimately, there was something like 5 million foreclosures avoided because of the mortgage modifications that we supported directly and put money behind, and because of those that the private markets did on their own on the model of our programs. That 5 million, it wasn't 10 million, but it couldn't really have been 10 million. It was probably going to be 5 million no matter what because there was a whole range of people who had financed a second home or financed a home that was just going to be unaffordable for them in that context. And so there was a limited number of people we could reach. So the basic constraint on doing more quicker was in part because we were working through a pretty broken banking servicers industry. We had to go work through those pipes, couldn't go around them. And they were terrible. Terribly staffed, terrible resources, and way inadequate to a calamity like this in that context. But again, we did as much as we could with the authority we had. We had all the right incentives. We had just demonstrated we could be enormously creative on a range of other things where we were taking a lot of risk. We brought that same mix of talent with a bunch of better housing talent to it. We looked at every idea that was out there. And again, we had a president putting enormous pressure on us to try and do it. And in the end, though, the reach of our programs, it just wasn't enough, wasn't strong enough, wasn't large enough relative to the force of the pressures.
Within that, though, one of the arguments people make is that you guys actually relied too much on the pipes, on the existing housing market, that what you should have done was push much harder for what folks call Cramdown and use the legal system to reduce principal.
Yeah. The president supported what you call Cramdown, this is bankruptcy reform, to give the borrower a little more leverage in renegotiating their mortgage. Good idea. He supported it when he was a senator and a candidate. And we tried twice in Congress to get that through. And again, we had a supportive president, a pretty talented legislative staff at that moment, and they run against a pretty immovable force in terms of we couldn't get enough Democrats to support it.
How hard did you guys try that? Because when I spoke to people in Congress who were behind Cramdown, they did not feel that they felt that the White House kind of pro forma supported it and did not put their shoulder into it.
Well, my view is you had the president of the United States who was for it. He wanted it. He thought it was important. He'd campaigned on it in some sense, and you had a pretty talented, pretty creative staff at that point with the right incentives. So my sense, just watching from a distance, and I wasn't the main architect of this, was that they worked at it and they were unsuccessful. But You have to be a little realistic about what the alternative could have produced in that context. It's not clear that would have given such a dramatic change in actual leverage. You'd still be working through the same pipes, maybe worse pipes, because you have to go through the court system or outside the court system. So I don't think it addresses the concern you raised about whether we were mistaken to rely on the existing plumbing. The other thing people suggest is, why don't you just create your own plumbing? Create a whole institution separate, going around all that broken plumbing of servicers, and try to provide a direct response mechanism to homeowners. But our judgment was, and I'm very confident in this, is that would, Congress would have to appropriate money for that. That's creating a whole new government agency. It would have taken a really long time, really complex to do, probably would have been slower than working through those existing pipes and doing what we try to do to get them working more quickly. Anyway, the most frustrating thing for all of us, the most disappointing outcome, but the outcomes were more a function of the basic constraints we were facing than they were a function of either lack of incentive, lack of effort, lack of creativity.
To actually look forward for a second, the other big thing that you guys did around the crisis was attempt to keep another one from happening.
Right.
And those rules, Dodd-Frank, some of them are now in place, some of them are still working their way through the regulatory process. And when I look at them, when I try to sort of figure out how to tell myself the story that I don't need to keep my money in the mattress, the thing that worries me about them is that they seem to me to give regulators, they put a lot of faith in the regulatory system, and yet the periods of time in which crises happen are the periods in which regulators are the least likely to use that authority. Right. I mean, I think there's a very good case to be made that Alan Greenspan could have stopped this crisis from happening in the early 2000s, that there were things that regulators could have done in terms of forcing more capital on banks, in terms of being much more aggressive in terms of regulating how the housing market was moving at that point, that really could have mattered. But people psychologically, a lot of the folks in power, didn't think they needed to. And that is endemic to the periods that create financial crises. If people were looking for the crisis, they would stop it. So why are you confident that Dodd-Frank has created a situation in which the next time we're in this kind of a build-up, regulators will want to use the tools and the authority they had? Because the other option is doing much blunter rules, like, people talk about breaking up big banks, but even more to the point, having very raw, crude leverage ratios that you can't, that you just had to keep a lot more capital on you at all times.
Good question. So let's do the causes, then I'll explain the theory behind our basic response to reforms. This crisis was so damaging because of the panic. And the panic was the result of the fact that over time, our financial system outgrew all the protections we put in place after the Great Depression. So we had a set of constraints on risk-taking in banks, around banks, that we think in retrospect weren't conservative enough, but they were conservative enough so that there was a huge buildup in risk outside the banks where it was unconstrained. Mm-hmm. So risk was just able to migrate around that and go into a set of institutions, very large ones, investment banks like Lehman or Bear Stearns or the rest of them, AIG, GE Capital, Fannie and Freddie, that existed outside those protections and were terribly vulnerable to panic and runs. That's what caused the crisis. So when you think about what the best defense about that is, what you need to do is to make sure not just that you have thicker shock absorbers around banks, better constraints, simple constraints on risk-taking, but they're extended broad enough so you don't recreate again a situation where banks are a small fraction of credit and all the risk and the panic vulnerability is out there. That's why our crisis was so damaging. That's why it's so hard to arrest. Now, on your basic theory, though, I very much agree with you, which is you don't want to design a system that depends on agile, prescient regulators with perfect foresight, no political constraints, tightening up these rules in a discretionary basis as things feel kind of frothy. Because there's just a risk that they'll be late or, I don't know, indifferent or sort of think it's a new normal kind of thing, great moderation kind of thing. So you don't want to do that, and we tried not to do that, actually. We had a more simple imperative, which is very similar to what you said, which is we said, most important thing you can do is to make sure you have much tougher constraints on risk-taking applied more broadly across the system so that you can be closer to be able to be indifferent to the fate of individual institutions. You want a system, as Larry used to say, safe for failure. And the theory behind our reform is very much like that. It's saying you get these things thicker and you keep them thicker, and you apply them more broadly. And it's the best defense against panics you have. And the most important thing done in those reforms was those set of changes to the regime of capital. And they're dramatically more conservative today, and they're applied more broadly. Now, over time, like water flows around stones in a river, risk will migrate around that. It's the forever war. You got to keep at it, keep looking at ways to make sure you can protect against that risk. But it's much better against yours. Yours is the right standard, because again, you don't want a system that's vulnerable to the wisdom and courage of regulators that depends on foresight and preemption, because financial crises really aren't amenable to that.
So I have a couple of very specific questions about your book. I would like to hear more about the time you called Dinesh D'Souza a dick.
I don't know if I can say more about that. Well, I tell a story. I went to Dartmouth College. I met my wife there, and I don't know if you remember at that time. That was a time when it was the early.
I do not remember the time when
you were born.
College.
You were alive. You were alive. It was a time when there was the early stage of the conservative movement among college campuses, and Dartmouth was one of the epicenters of that movement. We see the echoes of that today across the political system. And there was a group of conservative students at that point that started a newspaper called the Dartmouth Review. And they published on their newspaper a confidential list of members of the Lesbian Gay Student Alliance. And including on, there was a bunch of people who hadn't come out to their friends or their parents. And it was devastating to them. Did it without their consent. And so I ran into him in a line at the dining hall or one of the cafes and said what you quoted.
What did he say in response?
I don't remember him saying anything in response.
You were a Republican in college, you saying that?
I was, although I wasn't really I'd never really been a political person.
And your family, one of the things that actually surprised me in the book was that your father voted for Mitt Romney in 2012.
He did, yeah, I was surprised by that too. Actually, I wasn't that surprised by that, but he's a sort of classic moderate Republican. I think of it that way. He voted for Obama in 2008, but he's a more conservative person by instinct. So it wasn't that surprising to me in 2012.
Was that you weren't able to win that argument?
I didn't really try to talk him out of it. I mean, first of all, he has his convictions. I was doing my thing. I didn't really think it was my job to try to change his mind.
One of the things that comes up a lot in the book, and I was surprised because the book is in a lot of ways actually more personal than I would have thought, and primarily in this way. There's a lot of guilt in the book about how you were as a husband and as a father during the years you were in Treasury. This is not something I'd ever heard you express before publicly, but it recurs sort of throughout the length of the book. I'd be curious to just hear you say a little bit more about that, about the interplay between, on the one hand, trying to be in a position where it's public and it's incredibly important what you do to hundreds of millions, and arguably if you take the global view, even more than that, people, and then also trying to be a human being on the other side of it.
Well, it's a kind of a terrible tension, an irreconcilable tension. My work was hugely compelling to me, and at times it felt very consequential, and I had no control over its claim on my time. It's not something I could control at all. And if you're raising a family, it means that you're going to miss huge parts of their lives, and you're going to put an overwhelming burden for being a parent on your spouse. Pretty unfair burden. And then you inflict on them again the additional burden of having a father or a mother in public life. It's a huge loss of privacy to them, and you don't want your kids to be defined by the profile of their parents. It's not a very healthy thing for them. This is a very hard thing to do. I mean, I love my work. I felt really lucky to do it, and I had an amazing marriage, amazing wife, amazingly supportive kids throughout that period of time. And I think because of them, because of how supportive they were, I was a better decision maker than I would have been. I was a more careful decision maker, more thoughtful than I would have been. So it was a great benefit to me, but hugely costly to them.
I was thinking when I read it about, I mean, you were an unusually young Treasury Secretary, at least in the modern era. And we're at a point right now, we just saw the inauguration of the first female Federal Reserve chair. We've never had a female Treasury Secretary. And one of the things I was thinking about reading some of that was that it seemed that it was possible for you to do because you did have kind of an amazing wife who's willing and capable of taking on more of that burden. And in a gendered way in this society, that would be a lot rarer for sort of a young female civil servant who had kind of risen to your level. I'm curious what you think about the tensions that the sort of the pressures on the family play in terms of who actually can sort of rise up, or how many women can rise up, who have families can rise up to the very top levels of positions of power in politics.
I mean, my wife had a profession. She's
yes,
a
I don't mean
therapist, and she had a private practice, and then she became a writer. And that profession gave her, in some ways, more flexibility than I would have, and that was sort of a necessary part of making this work, because we wanted to be really engaged in raising our kids. But I think you're completely right. Now, I would say, though, that at Treasury, during that period of time I was there, those 4 years, there was a huge number of senior women in those jobs, many of them with kids. And so it's not like it's not possible to do. It's possible, but it puts a really difficult set of choices on them and a much harder thing to balance.
Do you think it's in general harder on women?
That balance?
Yeah.
I think it's harder on many women. I do think it is. You know, of course, lots of people find their way through this. It depends a little bit on the choices their spouse makes in their work.
When you left Treasury, which wasn't that long ago now, how long have you been out?
About 1 year and 3 months.
Are you happy to be out?
Well, I love my work and the people I work with, but you know, it was sort of time.
Yeah.
It was time.
There was a big guessing game in Washington about where you'd go. Yeah. And one of the things that there was a lot of fury about during the period of the financial crisis was this feeling of a revolving door between Washington and Wall Street. And you had, I mean, in the sort of highest profile post-crisis, I think, example, you had Peter Orszag go to Citigroup, which is one of the institutions that ended up getting a lot of bailout money. But prior to that, you'd had a lot of folks from Goldman Sachs become Treasury Secretaries. I mean, there really felt to people like...
And many people thought I came from Goldman Sachs.
Yes, many people thought you came from Goldman Sachs. And you didn't go to an investment bank, but you went to private equity. Right. And I'm curious sort of about that decision, both for you personally, but also why does it seem, or why is it the case, in fact, that so many economic policymakers end up in some dimension of the investment world as opposed to at sort of name brand companies that produce things that people hear of? I mean, you hear about a lot, Larry Summers, for instance, consults for D.E. Shaw. What you don't hear a lot of is, oh, well, this top policymaker went to General Mills and is now involved in managing their production process.
It's a good question. I'm not sure I can speak to that other piece of it. Can I explain my piece of it? And I can maybe talk about that. I had this great privilege. I spent all my life doing this one thing, but I couldn't do it forever. And I needed to do something new, and I wanted a different kind of challenge. And I was very worried about this perception, and I thought about it quite a bit. And I did not want to go work for a firm that we had regulated or that we had rescued. So I tried to be as remote from that as I could, and I was very careful in trying to make sure I was working with a group of people that I thought were very ethical and who were doing something I thought was valuable, and I feel very lucky in that basic choice. Now, on your broader question, and I agree with you about the perception, I think it's a very damaging perception. The typical thing is people who go run Treasury or go run senior parts of Treasury, understandably, people look for people with financial experience. Mm-hmm. And that's a good thing. It's not a bad thing. Because you want people who are working on the side of the American people who have the knowledge to be able to make good decisions about how to protect their interests in that context. And that does require experience. Now, a lot of people think that experience is tainted, and it's complicating in that sense. But I think you're probably better with it than without it. And it's that reality that creates most of this impression of people when they leave going back into finance. Now, it's true you cited some examples of people who didn't come from that in that context. But I think even the two you cited had worked in that area before. But that's the typical thing. And it's nothing wrong with that. You just want to make sure you run a set of protections so that you eliminate completely the risk or the perception of risk that experience affects people's judgments when they're in office. And our system has very good protections against that.
What are the protections there that should make people confident? It is, I think, a difficult thing to believe that folks who have come from the world of finance will not in a very natural, very human, very sort of deep way have a particular affinity towards the arguments being made by the people they liked and knew. I mean, humans have a tendency to trust more things that come from trusted sources than from outside.
Yeah,
I take the point about the expertise, but what are the protections that make you confident that that isn't a problem?
Well, the choices you make in those jobs are subject to enormous checks and balances. First of all, as you pointed out earlier, most of the authority that matters, that affects the incentives in finance, affects what you do with the taxpayers' resources, are decisions that Congress owns. And where they delegate them, they're highly qualified. And there's a set of protections around when rules are written and how they're disclosed and put out for public comment so people can see them. And we try to go way beyond that too, and to make sure that when we put together a rather elaborate, complicated mix of financial programs in the midst of the panic, and we made the terms of those completely transparent to people so people could see them. So, you have to be very careful that the decisions you make are subject to, a very, very tough set of checks and balances so that you're never in the position where the private interest can, this is in the executive branch, can get in the way of the public interest.
When you look forward now, I think we just got word the other day that we're now in a expansion as an economy that is unusually long, that we've gone now an unusually long time for the American economy without a recession. And there doesn't look to be a recession right around the corner, at least. And yet, I think that the recovery simultaneously hasn't been as deep as people expected. And in particular, I think the main manifestation of that is you've got a lot of folks who've dropped out of the labor force. Right, exactly. So while the unemployment rate is coming down quite a bit, it to some degree understates the progress or overstates the progress we've actually made. Do you think that we've kind of entered a new normal, somewhat slower growth and somewhat less employment? Or do you think that the recovery is proceeding and will ultimately get us back to the kind of normal that we believed in 1999 and 2004 and 5?
I have the latter view, but it depends a bit on the choices the political system makes in the next few years or so. But let's just go back to the basic thing about why this recovery has been, only sort of like a 2% recovery a year rather than a 3.5% recovery. And of course, you know about this, written eloquently about it. A bunch of it is just because we had a terrible financial crisis that followed a wave of too much lending, too much borrowing, too much leverage, and as we worked through all those problems, it slowed growth. And so as Rogoff and Reiner have written, recoveries following financial crises, they're much slower, they're much more fragile, they take a much longer period of time because the things you're doing to repair the damage and heal and create a better foundation for growth, they slow growth in the short term. And then we had two other things that happened. One is we had fiscal policy in a little bit of premature austerity fever turned too austere too quickly. Deficit came down too fast, and that sucked about a percentage point out of growth for on average, most of the last 3 years, 3.5 years. And then we had some little bad luck in terms of some external shocks from Europe, Japan, some other things like that, and those were material in aggregate. The reason I begin with that, because if you look at the causes for why people have been disappointed by the performance of the economy, you can attribute more than all that disappointment to those identifiable factors. So you don't have to look for some new dark theory of our loss of the ability to
secular
produce.
Stagnation.
I think to explain the performance of the last 5 years, it's explainable in a more simple and somewhat more reassuring things because those are transitory things. So my own view is that most of what you're seeing today in the economy is just the echoes, the aftershocks, the tragic aftershocks of the devastation of the crisis. And most of it's a function of the fact that we haven't been growing as fast as we could grow. And those headwinds are receding now, and we have a chance now we can grow a little faster for a while, and that should help bring more people back into the labor force more quickly. Ultimately, we won't know the answer to your question until we get sort of through that and see where we are at that point. And I think it's right to worry about the risk that you've left people very underemployed, long time out of the labor force, and you have an education system that is not good enough, really, at equipping people to compete in this world. And those are things you want to work at. Need to work at relentlessly over time. So I don't think it's quite as dark as that perspective implies, but that's not a good reason not to worry about doing things like how could you get more infrastructure, create more demand and more jobs now, and how do you create better outcomes out of the education system so that we're improving the odds that people come into this pretty challenging world with a better set of skills to compete.
Your old colleague, Larry Summers, has begun considering this darker theory he calls secular stagnation. And when I spoke to him about it, one of the things he said was important was coming up with a test for how he'd be wrong. At what point, what is the information that would come in that would begin to make you think that we weren't just kind of in an extended period of bad luck or aftershock, but that something was deficient within the economy's either growth engine or its sort of distribution of jobs engine?
Well, you want to look at, short-term unemployment's back down to normal levels now, but long-term unemployment is very high. So you want to look at what happens, how quickly that starts to come down again, how quickly people start coming back in the labor force, and when do you start to see the conditions that suggest broader-based income growth over time. And there's reasonable basis for thinking that's going to happen as long as we're, creating the conditions that produce stronger growth. So if we have a period of relatively strong, a little stronger growth through better policies, and you're still left with this mix of bad outcomes for the average, for the median income, and for people long-term unemployed, then you'd worry. But again, I don't think, my view of this is, you don't have to debate the thing. We don't know the perfect answer to it. And don't let the debate get in the way of doing a range of powerful things we could do now that would be good independent of the outcome of that debate. It's not a good argument to change the obvious prescriptions for policy for the country now.